Carl ICAHN is ready to rumble. Are you? That's going to be our theme as we go ahead into the weekly outlook for the week of February 12th, 2023. A lot on deck this week. A lot of binary action. Last week was pretty tame. This week is not so much. So let's jump into it, shall we? Hey, I'm Josh. I'm the founder of Trade with Profile. We're a skill development firm specifically focused on traders who are looking to express and develop skills so they can be active in intraday futures trading via S&P, NASDAQ, Russell, and Crude. This is just how we start each week. We do daily plans to look for areas of interest, scenarios that we expect, behaviors that we're expecting, because at the end of the day, we're behaviorists. But we also take a weekly view. And so this is just top-down. What's the week ahead? What are things that we want to keep in front of us as we're making decisions? It's all about making better decisions. And we use the profile and profiling tools to arrange auction information so that we can find areas of price where we expect certain types of behaviors. So with that, let's jump in. And the place that we like to start is always by looking at kind of a macro story and reminding us of what is the macro story and you know, what are we trying to do? And there could be a number of things at play when you think macro. First is that price and narrative are not always in sync. But overall, here's where we're at. We're still in a fiscal market where we would say the Fed is against equities. We see this through higher interest rates and a reduction of the Fed balance sheet. Inflation is still at decades high. We get the next CPI release this week. That's going to be big. Higher inflation equals higher interest rates equals lower earnings per share equals lower prices. That's the narrative and overall expectation. So if you see price divergent from that, either price is leading the narrative or the narrative will lead and price has got to catch up. Interest rates are still expected to rise into the fall. So there is currently not an expectation of a pause anywhere, though that could happen at some point, maybe even the March FOMC. We'll keep an eye on that. And risk remains underpriced while Carl ICAHN is flipping the script. So if you're not familiar with Carl ICAHN, you know, there's a number of names in the investment world, what we call activist investors or guys who really have, you know, do a splash. There's Bill Ackerman, there's Carl ICAHN, there's really respected guys like Stanley Druckenmiller and Ray Dalio and obviously Warren Buffett, Charlie Munger. These guys do also have pretty typical scripts that they stick with. And one thing that was notable this last week is that we saw ICAHN kind of flip from a script that he typically speaks to. And this is interesting in terms of what we're leading into in the week ahead. And so I actually just wanted to show you this as an idea of like what exactly this looks like, so that you could get an idea. So what we're going to look here real quick is we're going to look at S&P futures, and we're looking at option chains on the S&P. And specifically, we're going to go down here to the options that expire this coming Friday and the 40-50 strike, okay? And you can see right now there's open interest of 21,443. There were 2,900 contracts that were traded on Friday. We're going to actually go and send this to a chart, because what I want you to see is I want you to see what it looks like when somebody makes a big, big move, okay? So what we're looking at is we're really looking at the price of that option. And that's why there's like, you know, little holes in the chart is because, you know, they don't always trade all the time. And so they can kind of jump from price to price whenever there's a fill. Down here, though, is some volume. And if you'll notice, back here on Wednesday, there are two rather large spikes in the volume. And if we go and zoom in here, we're going to see two orders, one that equaled about 12,000 contracts and another one at about 11,000, total somewhere in the neighborhood of 24,000 contracts. At the time, bought between 18 points to 20 points and, you know, roughly is worth about $24 million. Okay. So this is insightful and interesting. One of the things that's really cool about options is that you may have heard of things like dark pool or people hiding shares or hiding trades, but options are what's called national best bid, meaning that every option trade is transparent. They're not option trades on equities or futures that are hidden from the general public. So sometimes we can see larger trades. I mean, clearly you can see within this specific contract by virtue of there's not really anything even close to the number of volume that took place on Wednesday, that we can infer some larger moves. Now, what's unique here is these were purchased as you can see, since the purchase, the price of these puts have gone higher. If we are one tick above 40.50, the strike on Friday, they're worth 0. All of the intrinsic value, gone. However, if we look at this and analyze this, so let's go back. We're going to go and look at this trade here. And we're going to buy single, and we're going to say that we bought them an average of 20, and we did 24,000. Okay. Let's just confirm what that's going to look like. So that is max loss of 24 million on the trade. Let's analyze this, so you can see what the curve looks like in terms of like where we are. So the purple line is the theoretical. The expiration is the blue line. So you could see that they're worth 0 if we are above 40.50 at expiration on Friday. However, I mean, they can exponentially increase. And let's say that we happen to get to 3,900 S&P this week, which is outside possibility, but could happen. Okay, what are these 24,000? So this number that you're seeing here, that's about 568. Let's see. Yeah, 568,626,545. If we're at 30, oh, I'm sorry, that's 3,800. We're not going to get that far. Something more modest, shall we say. So we're looking at 368,151,337 is what they're worth if we are at 3,900-ish at expiration. So pretty big explosive bet to the downside. They're already up a little bit, as you saw on the chart. But typically, we see guys like this selling puts, and in this case, they're buying puts. So when we think about what's happening in a macro and what we've got coming ahead in the calendar this week, and that's the next place we're going to go, is looking at the calendar and seeing what we have ahead of us. We see some moves that maybe there's greater concern, and that these large institutional players are recognizing that prices we're underpriced risk relative to what's coming up in the week ahead. So, and what is big this week? CPI. Tuesday we have CPI. That's huge. Everything's going to be about that. That's going to happen before the open. That's going to be a big mover. I think even more than the last one, which was kind of a dud, but pretty big. Then on Wednesday we have not a whole lot going on, but it doesn't show up here, but we do have VIX expiration on Wednesday. Thursday, we've got some PPI, some Fed speak. That's another inflation-related data point. And then on Friday, not here, but OPEX is what is in play. And so given that even a trade like that one from ICAHN, that as that price goes lower, or more, if more people buy puts, that's going to put pressure to keep that going lower, and dealers will have to sell. But on Friday, that put doesn't exist anymore. It either converts to cash or they sell it or do something. It doesn't exist. And so its influence in the market will be gone after Friday. And that's what OPEX is really all about. But as we're heading into OPEX, it's helpful to look at in terms of expectations this week and kind of where we are. And when I say that the risk is underpriced, and I'm looking at where we are on the VIX curve, and we've got our short end curve, our midterm curve, and the combined curve. And we've really spent all of 23 in really not convicted one way or the other. We've seen some inversion in the short end curve. That's largely come actually from an explosion in call volatility, not put volatility, but we are going in with an inverted curve. What would tell me that we were likely to move higher out of whatever happens this week is if we got both ends of this curve up and inverted, kind of like what we've seen back here, right? When the longer term curve, which what that would mean is that would mean participants going into, they had greater concern for the markets. They're going to go into later expiration options. When that happens, there's more of that stuff to burn off once we get past the event, and that's what leads to pretty predictive higher prices. However, as long as these are divergent and we're kind of in the middle, we can go either way. But with the longer term stuff not inverted, there's a degree of price that's under, or risk that's underpriced. And so we remain vulnerable to the downside. Something to pay attention to is that what would likely happen either tomorrow and into the CPI, we could see increasing hedges and people reaching for short dated options and stuff into that event, and then see if they add into it depending on how we react, following days. So that's what we got on the calendar. With that, let's now start our review and plan of all of the key products that we like to look at. And we're going to start with the S&P 500 futures and start with a review last week. So the posture of the auction and where that was and we came in equal to the 5-day, above the 20-day with the key price at 41.47. And we were looking for a range between 40.40 and 40.55. Buyers were, in control above 4,100, and we were looking for 39 to 89 to 40.20, the key composite support. Above that, key resistance. We were at key resistance. Next would be 4,300. So early higher prices take us into extreme, likely to fail, back to 41.50 for balance, below 41.50 and into ping pong, back to 39.89 and 41.50. When we go and look at the chart, so we talked about 4,200 being the resistance, and then this being kind of the key support area. And what do we see is we see kind of a little bit of balance and then a push higher in the week, and then fails right back to those composite prices, and then fails later in the week on the way down. However, when we look at the week relative to the prior week, we have an inside week. So what are we looking for in the week ahead? We are looking for a couple things. One, we're in what's called a ping pong posture. Okay, so we're below the 5-day and we're above the 20-day. That means that value will typically resolve to one of these two, meaning we're going to spend more time at one of these two. Sellers are in control below this price. Buyers are in control above this price. And so we'll have to see where we are at post CPI relative to these prices. If we're above, then we can push to new weekly highs and push up towards, I'd say 4,300 could be a stretch and possible. If we take out last week's low, then that could put us on a potential to even see 38.50. So our expected range being from 39.93 to 42.05. We could stretch that just depending on how much is in play. If we back up and actually look at the larger chart, we'll even see that we're kind of playing between a couple different ranges. There's a 4,100 to 4,200 bracket. And then there's a larger bracket that goes from here to here. So which one are we going to be in? If we're in this one, we can push toward this direction. If we're in this way, we'd push up toward 4,300. So I'm very interested to see where we are relative to these two prices post CPI. It's going to be, I think it's going to be challenging, and we're going to have to see which way we go. Ping pong between those two key references. This is why we use that posture. It really helps us. So again, just in expectations, we're in between 39.89, 41.25, key to watch. Looking for about 151 points this week between 39.93 and 42.05, the expected range. If we're above 4K post CPI, we can see 4,300. If we're below 4K, we could see 38.50. Inside week, looking for a breakout. All right. Let's jump over now and talk about the NASDAQ. So in review, what were we looking for? We had buyers above 12,300 with a ping pong posture last week. We were looking at 12,800 as a key reference above us and had Powell speaking, expected range. What were we really looking for? So we said, hey, if we had early liquidations, we could test 12,300. Buyers return to 12,800, but if we go later, like late in the week, that puts us back towards 12,100 ultimately. When we look at the chart, so here's the 12,800. We're looking at weekly, so you can see inside week. But here's that 12,800 area right up here. Went up and tested that early, could not get above it, and then came back down towards 12,300 later in the week. 12,100 is still down here. We haven't quite made it back to the scene of the FOMC, but this does change the posture for the coming week and in terms of the expectation, because now we're in a situation where price is below. So we have 5-day and 20-day right in here, and price is below that. So buyers have the ball below this price, or I'm sorry, sellers have the ball below this price, buyers above. Watch the highs and lows. To the downside, we're looking for a move back towards 11,935, larger composite. If we went to the upside, we'd go towards 13K, 13,200. Monthly expected highs up at 13,000. But again, with the binary moves of everything in play, we could go either way. And 12,550 is going to let you know. So where we are relative to that price post CPI, if we're below it, we're looking for 11,935. If we're above it, we'll be looking towards 13,000 plus. Okay, that is what we're looking for in the ES. So price below the 5-day equal to the 20-day, 12,550. Key to watch as the week goes ahead. Let's jump over to the Russell and get a sense of what we were looking at there. Buyers above 1885 with price equal to the 5-day and above the 20-day. 1939, the key reference. We did have Powell speaking again. 1949 to 2037. Largely stayed inside of that. Of the scenarios, early liquidation tests the 1750 to 1950 bracket. What did that look like? So when we go and look overall, we'll start here with the weekly, and we can just see that last week, the prior week was a large range week. This week we came in and really just traded all the way back towards the top of that 1750, 1900 bracket. Now we're close. We're in a new posture as we come into the week ahead, and that is below the 5-day and above the 20-day. We're closest to the 20-day, so I would expect that this is going to get tagged and bounce, but we're going to be at one of these two prices. However, notice after the big push last week, that's taking us all the way back here. So what does that portend as we look at the larger chart? We are still in a larger range that goes from 1700 up to around 2030. But we're about to go into a range from 1900 to 1750. So if we're inside or below here, we can start making our way toward 1750. If we can get above the 5-day, 1965, then we can look for 2050. Chop between that. Okay, but this certainly looks like sellers overall are holding it. So sellers hold it below this, buyers above that, buyers give up. We're on our way back in this direction. And we've got the catalysts and stuff to make that happen this week. Okay, let's get over to crude oil. Take a look at the expectation. So last week we came in a extreme posture to the downside, and we said, hey, that's not a place that you want to be chasing this thing to the downside. And instead, you want to look for early opportunities lower to get long back toward 76.40 area. And if we could get above that by the weekly close, we could go for 78, which is a big, significant reference. What did we get? Oh, look at this. We got early lower prices and a reversal and a push back to 76.40, and then above that late in the week, and we're back to 78. Solid. Fantastic opportunity. Really played well. Back to key composites and a little pop in the week. In the week ahead, we still have these poor weekly highs back up here to 83, and those are definitely on the radar as we're coming into the week ahead. So what are we looking for here? We are looking for buyers above 78, with 78 kind of being the the key reference. We do have OPEC monthly report on Monday and then EIA on Wednesday. Expecting about $4.53 from 76.55 to 82.89. Could be that range. Now, last week was an engulfing bullish week, so we're expecting continuation higher towards 83. The January VPOC is at 81.16. That's the first hurdle. And then we get to 83. If we can get some early pullbacks in the week that don't get past 76.60, so where those are is if we get early pullbacks back into this area, I think that gives us an opportunity to go this way. We could just run right up to 83. So there's very supportive in here. Early pullback that doesn't get below this buying excess on a way towards 81 and then on to 83. So we're looking for in crude. All right. All right, let's look at other ideas that were in focus. And this week had a couple that played out rather well, and some that that passed. So let's go to the open trades real quick. Talk about those. So crude worked really well. Actually, still long crude. That initial stop was 17.95. Entry was 73.50. Got to the first target 76.45. Now we're defending that 76.70 area. That's continuing. Still have the ES short butterflies. I have my Qs short. Haven't added to that at all. Just waiting those MNQs. Did add the ES short that we talked about last week below 41.35 post Powell's second commentary towards the naked VPOC at 40.78, and that worked well. Active ideas for this week, or active ideas for last week. So there was an exhaustion straddle on Meta. I passed on that. I did not take that trade. Let's look at a couple others that I didn't take but were valid. Let's go to soybeans. Had WASDA report last week. We talked about them bounce around 14.15. Not a lot of movement off of WASDA, but they did start to move from balance at the end of the week. So if you got that straddle, that one is working, and that looks really good. I got one new idea for this week. So that one is, I did not get that one. I was busy with the indexes, and that's okay. One I am going to be watching this week, just because of all the binary stuff. I'm looking at Google. That showed up as a potential straddle. And we've got a big composite note at 98.50, 99. We would be looking to buy that strike to push for 108.53 or 85.03. So those would be the moves. Targeting longer dated options out there, pushing for those extremes. So that's the idea that's in focus in the week ahead. And then finally, as we end this, we're going to talk about our development focus for this week, which is leaning into strength and not trying to front run it. Talk about this a lot, and this is one of those concepts that seems to be pretty challenging to get your head around. But once you get your head around it, starts to make a whole heck of a lot of sense. And how this plays out is, let's imagine, for example, that you see a market. Let's see here. I'm drawing on the right thing. Yeah. Let's imagine that you see, just making sure that I can, here we go. You see a market going higher, and everybody says, okay, I want to, where's the best location to get a short entry? And, they'll look at where this thing turns way back here, and they go, oh, well, up there, that was the best spot to get the entry. And I would say it's not. I would say that you're way early, and you are stepping out in front of it. May pay you well, but that's the hardest trade to take. You could flip the script and go the other way. If we're trading lower, obviously, where's the best trade location? It's going to be the very bottom. Those, however, are challenging to get into when they're first there. However, once we start to turn and confirm the turn, kind of hold and then push, that can be a higher confidence entry. So the key idea is you don't have to be first to win. Now, this is very different than or is not the same as trying to chase the market. This isn't I'm like I see a market going lower, and so I'm gonna now chase that going low. That's not what I'm talking about. I'm talking about identifying strength in the last impulse. Like, let somebody else be the first one to make a turn or to break out, and then you can join it. A couple ways to think about that. let's imagine, let's look at a breakout and let's look at a turn. So let's imagine that we're in balance and we see a break. Okay. Let's make sure that this break confirms, and things that you'd see like high R vol, you'd see high, buying deltas. You may see, big buying deltas this way. And then depending on what time frame this is, you'll see some accumulation in a smaller time frame of volume up there. Okay. And then what I want to see is I want to see the next time frame. I want to see it hold and maybe even pull back. This is the base of the spike. So I can effectively actually pull back in this direction. And unless I go back through it, I haven't negated anything. And then I'm looking for weak activity this way to join close to the stop and then push, or I can even wait for the break there and then bring my stop up here. I'm leaning on this strength, right? That's one way to do it. The other way is if I see a counter move, when markets are trending, there's going to be these counter moves, right? So, like one of the first things is to find one that stops that takes out one of those. And then that could just mean that we're just starting to balance and create a range. What you want to see is you see push, 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 counter, push, and then it gets a shallower spot and then breaks above this range, ideally towards some kind of composite target. And then from here, you're looking at, strong deltas, strong R-vol in the direction. The first one's just going to be, responsive. The first action is not a turn. The first action is a responsive, or somebody's taking pressure off. They're covering the positions they've already been in. You want to find the one that's actually going to stick and actually turn it. And that feels like you're late, but the confidence is so much higher. So consider that you're improving your performance by not sticking your neck out and you're waiting for somebody else, not trying to catch a falling knife. And this is identifying early strength and then looking to join responsive counter activity will certainly aid you as you go. Other ways to build skill this week, aside from leaning into strength, spend time with the 4 questions, follow us on Twitter, schedule an insight session if you dare, and get some insight up further if you dare. Do some intentional work with our development desk via one of the pathway options. And the software that we've seen here is EdgeClear and WindowTrader. Great guys, great platforms there to help you in your development. And then for those of you who are working through the pathway, I will see you on our development sessions and with our daily plans as the week progresses. All right, gang, that's it for this week. Big week, lots of binary stuff happening, lots of strength, early strength that you can identify and then look for opportunities to join that after it's confirmed. So great week to practice that development focus, and hope you keep your powder dry. It's still so early in the year and lots of great trading ahead. So hope you have a fantastic week. We'll talk to you soon. Peace.